this is important. We're going to talk about the difference between your emotional threshold for risk versus the risk capital that is in a funded account. In the example that we're carrying through here, the $50,000 account. So in that specific account, we have $2,500 worth of risk capital. 2,400 minus 100. Once you get to that last 100 in that account, you'll get a notice and the account will be shut down. So now you're not even factoring in the fact that threshold can eat up a small amount or a big amount of that amount. So what you find a lot of traders experiencing is they get to a certain percentage drawdown, then they go all in on the rest. And typically it's about 50%. So if you have a risk capital of 2,400 on a $50,000 account and you go down 1,200, all of a sudden the trader has the impulse to make that money back, goes on tilt and pushes to recover, and then experience a total blowout in that account. And the majority of the traders at some point, they experience that type of behavior, and it's fairly destructive, and it counts for a lot of the blowouts in these funded accounts. So you have to look at yourself in a serious way and ask yourself, what is my emotional threshold? At what point does the wheels go off and I start tilting and going all in on the remainder of the account? It could be 25%, it could be 50%, it could be 75% of the total amount of the account. Each one of us is different when it comes to this. But your awareness of what would trigger you is very, very important. You need to know that number. And once you know what that number is, the bigger question comes in is how can you prevent yourself from getting there? And the second thing is, if you find yourself in that spot where you're down 50% on the account, how do you recover in a sensible way to preserve your emotional capital along with the capital left in that account? And the key to it is a couple of things. One of them, if you find yourself down 50% on that account, the first impulse most people have, like we said, go all in. You counter that by saying the following: cut your size in half. Instead of adding more size, actually cut your size in half. So if you're trading one contract or two contracts, go and drop it to one contract, or even go down to 5 micros instead of trading the mini. That's the first thing. Under trade and lower the frequency of how many trades you take. And the trades you take, make sure they are very selective and of the highest quality according to your trading system. Okay. And at that point, my objective is, if I'm down 50%, is to work myself slowly, methodically, with calm demeanor from -50 to only -30%. So meaning I'm looking for an additional 20% gain. And once I get to that point, I feel like I'm out of this danger zone, and then I can go back up in sizing to one mini at that point, and go from there to recovery and eventually hitting our target of $3,000 on that account. Now, what happened if you're -50? Then you ended up digging a little bit deeper into this hole, even with the reduced sizing and selectiveness. That can happen. So you're down to 30%. Cut your size even further. Now, instead of trading 5 micro, trade 2 or trade 3, and keep working and try to get yourself back to 50%, then add size. Get back up to 70%, add size, and then you're out of the kill zone, you're out of the trouble area, and you're recovering and moving forward in that account. It takes a little bit of discipline and focus, and once you get there, if you get there, you have to take a step back and look at yourself and say, okay, this is the spot that I emotionally react to. It triggers me and I go on tilt. And my best decision that I can make right here and right now is step away from the computer and let me reduce size, let me reduce frequency, let me be selective and look at the highest probability and build up that confidence back up and that calm balance back up and move on to your target.